In the United Kingdom, inheritance tax is anchored to a very strict concept, the date of death valuation. When someone passes away, the government takes a snapshot of their total net worth. For tax purposes, the value of every house, stock, and bank account is locked in at that exact moment. But wealth is rarely static. Imagine what happens if the stock market crashes or property values plummet in the weeks following that death, before the executors even have the legal authority to access or sell anything. This chart illustrates the math of what we call phantom wealth. If the estate was valued high on the date of death, HM Revenue and Customs expects a 40% cut of that top-line number. But if the market collapses, the actual cash the executors can raise by selling those assets might be a ghost of its former self. They are effectively forced to pay taxes on money the estate no longer possesses. To prevent estates from being entirely wiped out by this timing discrepancy, the Inheritance Tax Act of 1984 contains specific remedial mechanisms. Sections 178 and 191 allow executors to substitute the actual lower sale price of an asset for its higher probate value. This recalculation triggers a refund. It converts a punitive tax bill based on theoretical wealth into a fair assessment of what the estate actually realized in cash. To reclaim tax on a devalued stock portfolio, the rules are unforgiving. First is the appropriate person rule. The person legally liable for the tax, usually the executor, must be the one who executes the sale. If the executor transfers the shares to a beneficiary and the beneficiary sells them at a loss, the relief is instantly voided. The type of asset is also strictly monitored. The relief applies exclusively to qualifying investments, which means shares and securities quoted on a recognized stock exchange, or holdings in authorized unit trusts. Unlisted shares and alternative investment market, or AIM, shares are explicitly excluded. Then there is the chronological deadline. To be eligible for this specific relief, the qualifying shares must be sold within exactly 12 months of the date of death. If you sell on day 366, the loss cannot be reclaimed. Executors also face the aggregation rule. You cannot simply cherry-pick the stocks that lost money and claim a refund on those. Every single qualifying investment sold within that 12-month window, even the ones sold at a profit, must be mathematically netted against each other to find the overall loss or gain. Once those sales are complete, the executor has to officially file Form IHT 35 with HMRC. This claim must be submitted within 4 years of that initial 12-month window closing. Navigating a stock portfolio through probate is precarious. Failing to perfectly align the aggregation rule with the appropriate person criteria can destroy the entire tax relief claim on a technicality. When we move from liquid stocks to physical property, the environment changes. Land is inherently less liquid, and tax rules adapt to reflect that reality. Instead of a rapid 12-month sprint, executors have an extended 4-year window from the date of death to sell land or buildings and claim a loss using Form IHT 38. To prevent a flood of minor valuation disputes, HMRC requires the drop in property value to be substantial. For a house valued at £400,000 for probate, it must sell for at least 5% less, a £20,000 drop, or at least £1,000 less, whichever is lower, to trigger the relief. The financial impact of meeting this threshold is significant. Because inheritance tax is levied at 40%, a property that sells for £50,000 less than its probate value translates directly into saving £20,000 in cash for the estate. There is also a hidden secondary benefit here. If an estate's total value was hovering just over the £2 million taper threshold, successfully claiming this property loss reduces the overall estate value. This reduction can bring the total back below the threshold, which reinstates the resident's nil rate band and restores thousands of pounds in tax allowances that would have otherwise been lost. Property gives executors far more time to act than shares, but those rigid percentage thresholds mean they must surgically time the market to ensure the loss officially qualifies. Executing these claims requires stepping through a field of anti-avoidance traps. The first is the capital gains tax trap. Claiming the inheritance tax relief permanently overwrites the asset's base cost for CGT. You cannot claim the loss for both taxes. You have to run the math and choose between saving 40% on inheritance tax or 20% on capital gains. Next is the repurchase trap. HMRC explicitly forbids executors from selling shares simply to crystallize a loss for the tax refund, and then buying those exact same shares back within 2 months. The supreme danger lies in making a disadvantageous claim. Once Forms IHT 35 or IHT 38 are submitted to HMRC, they are completely irreversible. Because of the aggregation rules, if an executor miscalculates and includes a property or stock that actually went up in value, they might inadvertently generate a higher tax bill, and they cannot withdraw the form to fix it. A successful claim rests on 3 unforgiving pillars: the correct person executing the sale, within the correct statutory timeframe, while perfectly calculating the aggregated totals. Please note that this information is for educational purposes. UK tax rules are complex, strictly enforced, and subject to change. Navigating these irreversible rules requires absolute precision. To secure your estate's true value without falling into a compliance trap, reach out to the professionals at Pro Tax Accountant. And if you found this breakdown helpful, make sure to subscribe to the channel for more insights.